In this video, we are breaking down 3 energy stocks with massive upside ahead that could benefit from one of the most powerful shifts happening in global markets right now. These are businesses positioned to generate cash, scale operations, and reward investors as energy demand continues to rise. What you are about to see are companies that control critical infrastructure, produce high-margin resources, and operate in segments where supply constraints can drive long-term pricing power. These are the kinds of businesses that can compound wealth quietly while the market focuses on short-term headlines. Let's start with the first one, Energy Transfer Partners, ticker symbol ET. To understand why energy transfer matters, you need to understand how energy actually moves. Most people focus on oil prices or gas prices, but the real backbone of the energy industry is infrastructure. Pipelines, storage facilities, and transport networks are what allow energy to flow from production sites to end users, and this is exactly where Energy Transfer dominates. Energy Transfer operates one of the largest and most diversified midstream networks in North America. Its assets include thousands of miles of pipelines, storage terminals, and processing facilities that handle crude oil, natural gas, and natural gas liquids. This is not a business that depends heavily on commodity prices in the same way producers do. Instead, Energy Transfer generates revenue by charging fees for transporting and storing energy. That creates a more stable and predictable cash flow profile. Think of it like a toll road. Whether traffic is high or low, the operator still collects fees, and in the case of Energy Transfer, that traffic is the flow of energy across its network. Now here is where things get interesting. Global energy demand is not going away. In fact, it continues to grow, driven by population growth, industrial activity, and increasing energy consumption in developing economies. At the same time, building new infrastructure is becoming more difficult due to regulatory hurdles and environmental concerns. This creates a supply constraint. And when you have limited infrastructure and growing demand, the value of existing assets increases. Energy Transfer is sitting right in the middle of that dynamic. Now let's talk about the financial side. Energy Transfer has been generating strong cash flow, supported by its fee-based business model. A large portion of its revenue is backed by long-term contracts, which provides visibility and stability. This is important because it allows the company to plan investments, manage debt, and return capital to shareholders with a higher degree of confidence. One of the key attractions for investors is the distribution. Energy Transfer offers a high yield, supported by its cash flow generation. While yields can fluctuate, the company has been focused on maintaining and growing its distribution over time. That creates a compelling income component alongside potential capital appreciation. Another important factor is leverage. Midstream companies often carry significant debt due to the capital-intensive nature of their assets. Energy Transfer has been working on improving its balance sheet, reducing leverage, and strengthening its financial position. This is a positive sign for long-term stability. Now let's talk about the moat. Energy Transfer's moat is built on its infrastructure. You cannot easily replicate thousands of miles of pipelines and storage facilities. These assets require massive capital, regulatory approvals, and years of construction. This creates high barriers to entry. It also creates a network effect. The more connected the system becomes, the more valuable it is. Producers want access to reliable transport. Customers want consistent supply. Energy Transfer sits between both, facilitating that flow. This position makes it a critical player in the energy ecosystem. Now let's talk about growth drivers. One of the biggest drivers is increased production in key energy regions. As production grows, the need for transportation and storage increases, which benefits midstream companies like Energy Transfer. Another driver is export demand. The United States has become a major exporter of energy, particularly natural gas. As global demand for cleaner energy sources grows, exports are likely to increase, driving additional volumes through Energy Transfer's network. There is also the potential for expansion. Energy Transfer can invest in new projects, expand existing infrastructure, and optimize its network to capture additional revenue. Now let's address the risks. Energy Transfer is not immune to challenges. Regulatory risks are always present in the energy sector. Changes in policy or delays in approvals can impact projects and growth plans. There is also the risk of declining volumes if production slows down in certain regions. And then there is the broader energy transition. As the world shifts toward renewable energy, there are questions about the long-term demand for fossil fuels. But here is the key point. The transition is not happening overnight. Traditional energy sources are still expected to play a significant role for years to come, especially in industries where alternatives are not yet scalable. This gives companies like Energy Transfer time to adapt and continue generating cash flow. Now think about the bigger picture. You have a company with hard-to-replicate assets, stable cash flow, high yield potential, and exposure to long-term energy demand, and yet it often trades at valuations that do not fully reflect its underlying value. This is where opportunity exists, because when the market underestimates the durability of a business, investors who recognize that durability early can benefit. Energy Transfer is not a flashy stock. It is not going to dominate headlines, but it is the kind of company that can quietly deliver strong returns over time, and sometimes those are the best investments. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second company on this list sits on the other side of the energy value chain. Instead of transporting energy like pipelines do, this business is directly involved in producing it, and that means its earnings can move much faster when energy prices shift in the right direction. Let's talk about Diamondback Energy, ticker symbol FANG. If Energy Transfer is the highway system of energy, Diamondback Energy is one of the engines producing the fuel that flows through it. And this distinction matters more than most investors realize. Diamondback is an independent oil and natural gas producer focused primarily on the Permian Basin, one of the most productive oil regions in the world. This region has become the backbone of U.S. oil production due to its low extraction costs and high output efficiency. What makes Diamondback particularly interesting is not just where it operates, but how it operates. The company has focused heavily on operational efficiency, capital discipline, and high-return drilling. In a sector where many companies struggle with cost overruns and inconsistent profitability, Diamondback has built a reputation for disciplined execution. Now here is why this matters in simple terms. Oil producers are highly sensitive to pricing cycles. When oil prices rise, profits can expand rapidly. When prices fall, weaker operators can struggle. Diamondback has positioned itself on the stronger end of that spectrum by maintaining relatively low production costs and focusing on high-quality drilling locations. This gives it resilience in downturns and strong upside in favorable conditions. Now let's talk about the business model. Diamondback generates revenue by selling crude oil and natural gas that it extracts from its wells. Unlike midstream companies that earn fees, producers are directly exposed to commodity prices. This creates more volatility, but also more upside potential. When energy prices rise, cash flow can increase significantly in a short period of time. And Diamondback has demonstrated an ability to turn that cash flow into shareholder returns. The company has focused on returning capital to shareholders through dividends and share buybacks while maintaining a disciplined approach to reinvestment. This balance is important. It means the company is not just chasing production growth at any cost. Instead, it is optimizing for returns on capital. Now let's talk about the numbers. Diamondback has consistently generated strong free cash flow, particularly during periods of favorable oil prices. Its margins tend to expand significantly when crude prices move higher due to its low-cost structure. The company has also maintained a relatively strong balance sheet compared to many peers in the industry. This financial stability allows it to weather volatility without taking on excessive risk. One of the key metrics investors often focus on is break-even oil price. This refers to the price at which the company can cover its operating costs and capital expenditures. Diamondback has worked to keep this break-even level relatively low, which gives it more flexibility across different market conditions. Now let's talk about the moat. In the energy production space, the moat is not about patents or software, it is about geology, efficiency, and execution. Diamondback's moat comes from its access to high-quality drilling locations in the Permian Basin, combined with its ability to extract resources efficiently. Not all oil fields are equal. Some require significantly higher costs to produce the same amount of energy. The Permian Basin is one of the most cost-efficient regions in the world, and Diamondback has built a strong position within it. There is also an operational moat. The company has refined its drilling techniques, optimized its supply chain, and improved its capital efficiency over time. These incremental improvements compound and create a meaningful competitive advantage. Now let's talk about growth drivers. The first driver is production efficiency. As Diamondback continues to optimize its operations, it can generate more output without proportionally increasing costs. The second driver is energy pricing. While the company does not control commodity prices, it benefits significantly when prices are elevated. The third driver is shareholder returns. As free cash flow grows, Diamondback has the ability to return more capital through dividends and buybacks, which can support the stock over time. There is also consolidation potential in the sector. Energy production remains a fragmented industry, and companies with strong balance sheets and operational efficiency are often in a position to acquire smaller assets or optimize existing ones. Now let's address the risks. The most obvious risk is commodity price volatility. Oil prices can fluctuate significantly based on global supply and demand dynamics, geopolitical events, and macroeconomic conditions. This means earnings can be unpredictable in the short term. There is also the long-term uncertainty around energy transition. As the world moves toward cleaner energy sources, demand growth for oil may slow over time. However, even in conservative scenarios, oil is expected to remain a critical component of global energy supply for years. Another risk is operational execution. While Diamondback has a strong track record, drilling operations are complex and can be impacted by cost inflation, labor constraints, and regulatory changes. But despite these risks, Diamondback remains one of the more disciplined operators in the sector, and that discipline is what separates long-term winners from companies that struggle through cycles. Because in energy production, survival is not just about having resources, it is about managing capital wisely across boom and bust cycles. Diamondback has shown it can do that, and that is why it remains an important player in the energy landscape. Now before we move to the final company, here is a key takeaway. Energy production is inherently cyclical, but companies that maintain discipline, focus on efficiency, and prioritize shareholder returns can still generate strong long-term value even in volatile environments. And Diamondback fits that profile. It is not the most speculative story in the energy sector, but it is one of the most consistent. And consistency, in a cyclical industry, is a powerful advantage. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The final company on this list operates in one of the most misunderstood and cyclical corners of the energy market. It is a business that many investors tend to ignore during downturns, only to rediscover when demand tightens and supply constraints begin to matter again. Let's talk about Transocean, ticker symbol RIG. Transocean is one of the world's largest offshore drilling contractors, specializing in deepwater and ultra-deepwater oil exploration. To understand why this matters, you need to understand what offshore drilling actually represents in the global energy system. While onshore oil production, like what we see in places such as the Permian Basin, is more flexible and lower cost, offshore drilling is far more complex, capital-intensive, and technically demanding. It involves drilling rigs operating in deep ocean waters, often under extreme conditions, to access reserves that are not reachable from land. This is not easy work. It requires highly specialized equipment, advanced engineering, and long-term contracts that can span multiple years. And that complexity is exactly what creates opportunity. Because when energy markets tighten and demand for oil rises faster than supply can respond, offshore drilling becomes increasingly important. It acts as a longer-term supply source that helps stabilize global production. Transocean's business model is built around providing these advanced drilling services to major energy producers. It does not own the oil, it operates the rigs that extract it, and it earns revenue by leasing these rigs under contract agreements. Now here is where the story becomes more interesting. Offshore drilling has gone through a long downturn cycle in recent years, driven by lower oil prices, capital discipline from producers, and a shift toward onshore production. As a result, many companies in this space have struggled with underutilized assets and weaker pricing power. But cycles eventually turn, and when they do, the companies that survive the downturn often benefit disproportionately. Transocean is positioned right in the middle of that potential recovery phase. Because as global energy demand remains resilient, especially in industrial sectors and emerging markets, there is renewed interest in long-cycle projects that can provide stable production over time. Deepwater projects fall into that category. They are expensive to develop, but once operational, they can produce large volumes of oil over extended periods. Now let's talk about Transocean's competitive position. The company operates one of the most advanced fleets of ultra-deepwater drilling rigs in the world. These rigs are highly specialized assets that are not easily replicated. Building new offshore rigs requires significant capital investment and long development timelines. This creates a natural barrier to entry. At the same time, older rigs are often retired or scrapped during downturns, which reduces overall industry capacity. This is a critical point, because when supply of rigs decreases while demand for offshore drilling eventually increases, pricing power can shift dramatically in favor of remaining operators. That is the cycle Transocean is exposed to. Now let's talk about financials. Transocean's revenue is highly dependent on contract utilization and day rates, which are the prices it charges for leasing its rigs. During weak market conditions, utilization drops and pricing pressure increases. During stronger cycles, both utilization and day rates can improve significantly, leading to sharp increases in cash flow. This makes the business inherently volatile, but also highly leveraged to recovery phases in the energy cycle. The company has also been working on strengthening its balance sheet and improving its operational efficiency. Managing debt is a key focus, especially in capital-intensive industries like offshore drilling where downturns can be prolonged. Now let's talk about the moat. Transocean's moat is based on its fleet of high-specification drilling rigs and its technical expertise in deep-water operations. These rigs are not interchangeable with simpler equipment. They are engineered for extreme environments and require specialized crews and operational knowledge. That creates a high technical barrier to entry. It also creates switching costs for customers. Once an energy producer commits to a deepwater project and contracts a rig, it is not a simple decision to switch providers mid-project. There is also industry consolidation at play. Over time, weaker players tend to exit the market, which can reduce competition and improve pricing dynamics for surviving companies. Now let's talk about growth drivers. The first driver is energy demand stability. While energy transition is ongoing, global oil demand has remained resilient, especially in transportation, aviation, and industrial sectors. The second driver is offshore investment cycles. As oil companies reinvest in long-term production projects, offshore drilling demand can increase. The third driver is rig utilization. As idle rigs return to service during upcycles, revenue can expand without requiring significant new capital investment. There is also a structural factor. Because new offshore rigs are rarely built during downturns, supply becomes constrained over time. That sets the stage for stronger pricing when demand returns. Now let's address the risks. This is the most volatile company of the three. Revenue is highly cyclical and dependent on global oil prices and exploration activity. If energy prices remain weak for an extended period, demand for offshore drilling can remain suppressed. There is also significant debt on the balance sheet, which increases financial risk during downturns. And operationally, offshore drilling carries inherent risks due to the complexity and scale of the projects involved. But this is also what creates opportunity, because markets often overcorrect in both directions. During downturns, assets can become undervalued relative to their long-term earning potential. And when cycles eventually improve, companies like Transocean can experience sharp recoveries in both revenue and sentiment. Now step back and look at the bigger picture. You have three different energy plays here, each operating in a different part of the value chain. Energy Transfer controls the infrastructure that moves energy. Diamondback Energy produces oil with disciplined efficiency. Transocean provides the specialized offshore drilling capacity that supports long-cycle production. Together, they represent different ways to participate in the same global energy system. And that system is not disappearing, it is evolving. Energy demand continues to be driven by population growth, industrial expansion, and global economic development. At the same time, supply is becoming more complex and capital-intensive. That combination creates opportunities for companies that can operate efficiently within their niche. Now here is the key question. Which part of the energy value chain do you believe offers the strongest long-term upside? Is it the stable cash flow infrastructure of Energy Transfer, the disciplined production model of Diamondback Energy, or the high beta cyclical upside of Transocean during energy upcycles? Drop your thoughts in the comments and compare which model you think performs best over a full energy cycle. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. At the end of the day, energy investing is about understanding cycles, discipline, and long-term demand. The companies that survive and thrive are not always the most exciting in the moment. They are the ones that control critical infrastructure, manage capital wisely, and position themselves for the next phase of demand. And as we move into a world of continued energy consumption and evolving supply constraints, these businesses remain central to how the global economy functions. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.